Okay, the next chapter has to do with loan approvals. I got to tell you, this is what it's all about. You know, we go through a lot of things, but unless that loan gets approved, we're not going to go to the closing table. So let's talk about what underwriting is all about. All underwriting is risk evaluation. In other words, we're going to evaluate two things. We're going to evaluate the borrower to find out if they're able to make their payments. We're also going to evaluate the property to make sure it's good security for the bank. So let's start out by talking about credit history and what a credit report does. A credit report is extremely important, and let me tell you why. It will tell us the willingness of a person to repay a debt. You can look at it and you can tell how their past payments have been, and it'll tell you how willing they are in the future. There are a number of places that we can go for this. Remember this also, that lenders are supposed to get written permission from the borrower before they pull that credit report. Also, when a credit report is done, what we have to look at is that anytime that you make a loan application, that's going to go in your credit report, and it's going to be there for 90 days. So if you're out looking at a lot of places, making a lot of applications, that's all going to show up in your credit report, and believe it or not, it's going to cause your credit report to go down a little bit. So we want to be careful about how many places we go out to make loan applications. Once a credit report is pulled, this is very important, that once it's pulled, that report is going to be good for 90 days to the date that the loan has been approved and 120 days to the actual loan closing itself. And if it goes past these dates, you've got to go out and get a brand new credit report done. So we want to make sure that we give ourselves enough time to get the loan approved, but at the very same time, we don't want to run over on these issues. Talking about why people have bad credit. Well, there can be any number of reasons why people have bad credit. First of all, delinquency. And what is considered to be delinquent? If you're 30 days or more overdue on a payment on a recurring debt, you're going to be delinquent. Bankruptcy, repossessions, bad debt placed in collection, and also foreclosure. Now, let me make a comment about bankruptcy and foreclosure. If you can reestablish credit and reestablish a credit pattern, typically you might be able to get another loan to purchase a home within 3 to 5 years, depending on the bank and depending on the circumstances at the time. So it's not the end of the world, but it is going to curtail your borrowing for a little while. As far as assets and liabilities are concerned, just remember that net worth is the difference between your assets and liabilities. And hopefully your assets are going to be more than your liabilities. If your liabilities are more than your assets, you're bankrupt, just to let you know. In terms of evaluating the property, remember we said a minute ago that we're going to evaluate both the person and the property. The way that we evaluate a property is that we have an appraisal done. I think it's important to know that most of our borrowing is going to come from a federally related lending institution. And that appraisal has to be done by somebody who is state certified. A regular licensee, a real estate broker, cannot do an appraisal for a bank in a loan situation. In evaluating the property, let's talk about market value and what that's all about. It's important to understand that to determine market value, which is the most common, that the buyer and the seller have to be, first of all, motivated. It's got to be at an arm's length transaction. Enough time on the market has to be expended to make it available. And it's got to be paid in U.S. currency or U.S. dollars. And let me explain what I'm talking about when I say arm's length transaction. Remember that a buyer is looking out for the buyer's best interest and the seller is looking out for the seller's best interest. A situation where it would not be arm's length if a mom and dad was selling a home to one of their kids. It may be perceived they may sell it for less than what market value might be. When the appraiser is doing an appraisal, there's going to be 3 approaches that they use. The comparable sales approach, and in the comparable sales approach, all they're doing is looking at other properties that are similar, that have sold recently. Probably more weight is going to be given to that than the others. Another way that the appraiser is going to value a property is the cost depreciation approach. Now let me say this. In the cost approach, what we're doing is we're taking the structure and we're building it brand new, and then we're going to subtract out any kind of accrued depreciation. And remember this approach, we're going to separate the building from the land. Typically speaking, we'll use this, but it's not going to be really that important unless we're dealing with a special purpose type building where we don't have comps. The other approach to value that the appraiser is going to use is the income approach. Now, in a residential home, they're going to use the gross rent multiplier to make the determination. And all you're looking at is the gross rent as it applies to some kind of market multiplier, and that'll tell you what the property is basically worth. Once the appraisal has been done, then what the appraiser has to do is something called reconciliation. And all reconciliation is a weighted averaging. He's going to take the three. Chances are he's going to give more weight to the comparable sales approach. Maybe 60% of the appraisal will go to that. And then the other 40% will be divided up among the other two approaches. The bank then is going to look at the loan-to-value ratio and try to determine, how much they're going to be willing to lend out. Remember that the loan-to-value ratio is simply a relationship between the loan amount that the bank's going to make as it relates to the value. And remember that the value is either going to be based on the contract price or the appraised value, whichever is the lower of the two. So when you're designing contracts, you need to be careful about what you put in, because just because the contract price is one thing does not necessarily mean that it's going to appraise for that. It may be more and it may be less. Especially if it's less, that means that you may have to recalculate what that loan amount is. So oftentimes what we do is use percentages instead of actual dollar amounts. The escrow account, and I think that what we're talking about here is that most lenders want to take payments and put them in an escrow account. And a lot of lenders require what we call a budget mortgage. A budget mortgage is simple. It's where you're making principal, interest, taxes, and insurance payments. Now, the way that you handle your taxes and insurance are typically paid annually. You're going to take that amount, that annual amount, and simply divide it by 12 and make it part of your mortgage payment. Discount points are prepaid interest. Sometimes lenders are going to require you to pay points up front. Basically, what you're doing is buying down the loan. Now, I want you to look at page 3-6 at the discount points. Chances are you're going to get one of those problems on your examination. The underwriting process, on page 3-7, let me say that the lender has to go through a process to make sure that you qualify. And there's some guidelines that they want to use when they do this. And they're probably going to ask for 2 full years of tax returns, unless, of course, you've got pay stubs and things of that nature. But one of the things that a lot of people don't understand if you're going from one job to the next, if there's more than a 30-day gap between employment, you're going to have to explain that, because that's not an ordinary thing that people do. So make sure that if you have somebody that's going from one job to the next, or at least they have in the last 2 years, that if they've had a gap, they're going to have to write a letter and explain that. Also, as far as rental income, I think what we can say is that there's certain rents that we can collect that we can use toward our income to as far as the loan is concerned. If you're going into a situation where you're leasing with an option to purchase, I think this is very important to understand. The question has always been, can my lease payment go toward my down payment? Probably not, and I'll tell you why. The only way that it can is if the lease is for more than a year, and that whatever portion of the lease payment was above market rent. So if it's just market rent that you're paying, you're not going to be able to add that into your down payment. Gift letters are also a common thing that we do today, but I think that it's important to note that if you're going to do a gift letter, that the borrower still has to come up with 5% down no matter what that gift is. And the only exception is if the gift is at least 20% or more, then that 5% is waived. The loan commitment is what we're looking for. And typically speaking, as I mentioned earlier, depending on which contract you've got, we give them a certain amount of time to have that firm loan commitment to come through. Before we ever get started, though, we want to make sure that we have a lock-in agreement. And what that lock-in agreement basically says is there's certain things that we want the bank to go ahead and commit to before we get our commitment. It has to do with the expiration dates, the interest rates, discount points, commitment fees, and any kind of lock-in fees. We want to know those up front. Once we get that commitment, what we're looking for is that firm commitment. That firm commitment simply says that you've cleared it and now we can move forward to closing. If somebody's doing a construction loan, typically speaking, that bank is going to say that construction loan is going to be good for 6 months or a year, whatever it might be. But I promise you, they're not going to make that construction loan unless there's a takeout. And that takeout commitment simply says is that we've got another loan already in place, a long-term 15 or 30-year mortgage that's going to take out this construction loan. Oftentimes when a borrower makes an application to a bank, the bank may come back and say, you know what, you don't qualify for this, but I'll tell you what we'll do. Instead of 5% down, we're going to ask for 10% down. That's called a counter offer. And so what has to happen is if the borrower now has to come up with 10% rather than 5%, they've got to say, can I do this or not? They've got 90 days to make the decision. And so if they can't make a decision within that 90-day time frame, what the bank is going to send out is called an adverse action notice. And what that basically says is that the loan that borrower originally presented was not acceptable, therefore the loan is going to be denied. Conventional mortgages, or the more conservative mortgages that we have out there, the conventional mortgages ratios are 28-36. In other words, 28% of your housing expense ratio, 36% of your total obligation. Those are the guidelines that they use. I think it's important for you to understand, though, that if you're getting a loan to value where it's greater than 80%, they're going to require private mortgage insurance on that 20% above the loan to value ratio. On page 3-12 is an example of that 28-36 ratio that I just mentioned, the housing expense ratio and the total obligation ratio. You're probably going to have to be able to work one of those on the examination as well. When we're dealing with the FHA loans, let me say this, that the FHA is an insurance premium and it insures the entire loan amount. Now the thing about FHA is it has loan limits. And as far as the insurance premium is concerned itself, the mortgage insurance premium is what we call it, and it's paid in two ways. One is paid up front. Secondly, it's also paid monthly along with the mortgage payment. The VA loan is a guarantee, and what it basically does, it guarantees that if a veteran takes out a loan, if that veteran defaults, the bank is going to be covered. Now, the VA being a guarantee does not guarantee the entire loan. It's going to only guarantee an upper portion of that loan. So the bottom portion is going to be subject to, I guess, deficiency. Also, let me say this, is that the VA loan, typically speaking, is zero down, nothing down, whereas your FHA is 3.5% down. And as a VA loan is concerned, typically that loan limit with zero down is $417,000. In other words, a veteran could get a loan up to $417,000 with nothing down. If they want to get a loan, let's say for $517,000, they can do that. That amount above $417,000, that extra $100,000, is going to require 25% down in order to get it. The underwriting for commercial properties, I've got to tell you, there are some lenders that will make loans on commercial properties out there. And they're looking for a number of, basically they're looking for ratios. They're looking to make sure that that property is going to be secure enough to be able to make those payments. And if you're looking in your textbook, page 3-19, I want you to look at a number of different ratios. Your debt service coverage ratio is one that's very important. And that's simply a relationship of your annual debt service, that's your mortgage payment, principal and interest, as it relates to the net income. And they want to make sure that the net income will support the debt service. Some other ratios are your operating expense ratio and your equity dividend rate. The equity dividend rate is simply a yield on the investment in the property. And with that said, that is all we have for this particular chapter. So what I'd like to do right now is I'd like to review this material. Those areas are going to be important to you. Loan underwriting is risk evaluation. In order for a lender to pull a credit report, they should get written permission from the applicant up front. Credit reports will identify all inquiries that were made in the last 90 days. Credit reports must not be more than 90 days to the approval and 120 days to closing. More than 30 days delinquent on a payment can cause bad credit. Assets are something of value, liabilities are a debt. So the difference between your assets and liabilities equals your net worth. All appraisals provided to lenders as part of the loan application must be done by someone who is state certified. An arm's length transaction simply means that the buyer is looking out for the buyer's best interest and the seller is looking out for the seller's best interest. The comparable sales approach is relied on heavily when we're doing residential properties. The cost appreciation approach is relied on when we're dealing with special purpose buildings. And the income approach is used when we're dealing with investment properties. Reconciliation, remember, is a weighted averaging of the three approaches. The loan-to-value ratio is a relationship between the value of the property and the amount of money that's going to be financed. Principal, interest, taxes, and insurance are considered to be a budget mortgage. Discount points are considered to be prepaid interest. Remember that for every point that a lender charges, it increases their yield by 1/8 of 1%. And the way that a borrower pays that at closing, 1 point will equal 1% of the loan amount. A person receiving a gift for their down payment will still need 5% unless that gift is for 20% or more. Excess amount of lease payments above fair market value can be counted toward the down payment and the closing costs provided the lease is for at least 12 months or more. A lock-in agreement includes expiration date, interest rates, discount points, commitment fees, and lock-in fees. A takeout commitment is required when a construction loan is being made. A counteroffer will be made when a lender does not accept the terms of the loan offered. When a down payment is less than 20% in a conventional loan, private mortgage insurance will be required. The housing expense ratio for conventional loans, 28% of your monthly gross income. The total obligation for conventional loans, 36% of your total obligations. The FHA has a mortgage insurance premium. It's paid up front and also part of your mortgage payment. The VA requires any loan amount above $417,000 to have at least 25% as a down payment. The debt service coverage ratio is calculated by dividing the property's net income by the annual debt service. And that's all we have for that chapter.